So welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have Euro USDs for our chart. The pair seems to be moving in a pretty tight sideways motion. It's characteristic how the pair has tested the 1900s, the 1.09 support line a couple of times, especially on Friday, where there was some sideways motion, but there was some volatility present, mainly due to the release of the US employment report, which was better than expected. And it was substantially better. It was a characteristic how the unemployment rate remained unchanged at 3.7, which is pretty low, even for US standards. The NFP figure as such more or less jumped to 216K. It was expected to drop. It didn't. It rose. And more or less the release highlighted the resilience of the US employment market. I would be noting here as well that the market tended to wobble a little bit, in the sense that for a short period, the market's expectations for 6 rate cuts in the current year were reduced to 5. Yet, I would say that the market remains unconvinced. On the contrary, it stands fast that the Fed will be cutting rates 6 times this year. And attention now turns to the release of the UCPI rates that occurred on Thursday, given the Fed's dual mandate, say, on the one hand, inflation, on the other hand, employment data. Let's start by adding some toolbars here. The chart's a little bit naked. Okay. Once again, we expect the sideways motion to continue, and we're basing this practically on 2 factors. A, the price action of the past 48 hours. That's since Wednesday, actually. And the fact that the RSI indicator remains below the reading of 50, but very close by. And in our opinion, that tends to imply a rather indecisive market. Also note how the Bollinger Bands have narrowed despite some increased volatility here. They have smoothened it out, while the 50 moving average is nearing the 100 one, but it's flattening out somewhat. It's also characteristic how the Bollinger Bands have flattened out. And the price action is exactly on the median, the 20 moving average. All of that tends to imply a continuation of the sideways movement for now. On the other hand, should the bulls take over, we may see the price action rising and breaching the 1.1005 and starting to aim for the 1.1130 prior peak. While we can see how the 1.1005, the R1, has found resistance here and here. So there was a double check, which actually enhances the validity of the resistance line. On the other hand, should the bears take over, we may see the price action dropping, breaching the S1 1.09, which provides support once, twice. Some even mentioned this scenario here as the 3rd time, and start aiming for the S2 1.0825, something which was low, which was tested to the upside here and to the downside. So that's pretty valid as well. Albeit we have to note here that the distance between the S1 and the S2 is pretty narrow. Okay, let's move now to GBP USD. Always in the 4-hour chart. Let's widen the chart a little bit. So we have seen how cable has moved decisively lower. has breached the 1.2720 and has moved in a sideways motion in a similar fashion like the euro in the forward chart. Note how a bullish triangle has started to form. But before we move on, let's switch this support line to resistance line, given that it has provided resistance, and go hunting for a new ultimate resistance level. This has to be a little bit readjusted. Could go lower. Let's correct also the contents of the labels, starting with the R3, which is now being placed at 1.29. Adjusting the chart. That's better. $1.2810 is now the second resistance line. The R1 at 1.2720. The S1 at 1.2615. The S2 at 1.25. And the S3 at 1.2380. Moving now to the 1 hour chart. It's interesting how there is a slight upward trend line here. You can see it. Back to the 4 hour chart. Adjusting it, repositioning the labels as well. Now we see the pair marking higher lows. I would maintain my doubts about higher highs despite the shadow here. It seems that the 1.2720 provides formidable resistance for the pair's price action, and that may keep it maintained. In both cases, though, there seem to be some slight bullish tendencies. But for a bullish outlook, I would require the pair to breach clearly the R1 1.2720 and stay above it this time, and start aiming for the 1.2810, a level which was tested here. The RSI indicator is rising slightly, but practically remains near the reading of 50, which also tends to imply a rather indecisive market. The 20 moving average has started to shift upwards. It's characteristic how it has crossed the 100 and starts aiming for the 50 moving average. It's going to be a wait and see position here. Should, on the other hand, the price action drop below the upward trend line we have just drawn, and respect, on the other hand, the S1 1.2615, then we may see the price action remaining confined in the corridor formed between the R1 and the S1, and that would be a nice, beautiful sideways motion. On the other hand, should the bears take over, Okay, definitely we would require a clear break of the upward trend line, but we would be also requiring a clear break of the S1 1.2615 and the pair to start aiming for the 1.25. Okay, let's move now to USD/JPY. Back to the 1 hour forward charts, zooming in a little bit. That's better. Let's reposition the labels. Now let's talk about direction. You can see how the price action has breached the upward trend line, which was guiding the pair since the 2nd of January. That's pretty clear. Now, there are some traders which tend to equal the breaking of an upward trend line with a trend reversal. That's not my opinion. I would expect the price action to maintain initially a sideways motion, or if you prefer, I would require more evidence of a bearish price action in order to start forming a downward trend line, say for example a correction higher and then a continuance lower below the S143.90, maybe with the price action starting to approach the 142.50. In that case, yes, we would be able to start drawing a downward trend line, which could be showing us also the limitations of the downward movement, and adopt a bearish outlook. Another indication which is interesting is the fact that despite the correction lower, the Bollinger Bands, actually the 20 median, the 20 moving average, which is the median of the Bollinger Bands, maintains an upward shift and tends to, on the one hand, suggest that the movement has not changed direction as such just yet. Also note how the RSI indicator, okay, it has corrected lower, but it still remains above the reading of 50, which tends to imply that the market remains rather uncertain about the future direction of the pair. In any case, should the pair be able to regain upward traction, then we may see it breaching the 145.20 once again, and this time remaining above it, and possibly start aiming for the 146.50. On the flip side, should the bears be in charge, I wouldn't be surprised to see the price action, okay, correcting a little bit higher, but then diving below the S143.90, nothing less than that would be convincing us of a bearish outlook. Next possible target for the bears could be the 142.50. Let's move now to AUD/USD. Let's clear the old labels. And at this moment, we definitely have a downward trend line. Let's zoom in a little bit. I'm going to be skipping this peak here and moving based on this shadow. And I think it's characteristic how the price action has moved below the 0.6535, and even the 0.6535 has provided some resistance. So let's turn this into a resistance line. Let's go hunting for a new ultimate support level. Albeit a bit narrow, you can see how this level provided support here. So I'm keeping this in green. 0.6450. Let's widen the chart a little bit. Let's correct the labels, starting with the R3, which is now being placed at 0.6910. The R2 at 0.6820. R1 at 0.6725. S1, let's have a confirmation that 0.6625, that's 100 pips lower. S2 at 0.6535. Sorry. And the S3 at 0.6450. Now, on the one hand, there is a clear downward motion, and that has begun since the 28th of December. You can see how the pair marks lower lows and lower highs. On the flip side, though, and it's interesting if we drill here to the daily chart, you can see that there was an upward movement. Like this. That has started since the early days of November, actually the 7th of November last year. Let's drill back to the forward chart. So it's interesting how practically a symmetrical triangle is being formed by the correction low of the pair. If you are in the daily chart, then practically this whole movement is a correction lower. It's as if, allow me to clear the chart. It's as if we had one, two. So that would be very, very similar to Elliott waves. One, two, three, four, five. And now we are about to enter A, B, C. That would imply practically, if the Elliott waves in this time apply, that would imply practically that we have a downward motion, which, despite a possible correction higher, would be ending far, far lower, probably around the S2, maybe even lower. Let's place some resistance and support lines here. It would be very interesting to note. Back to the forward chart. Actually, let's stay on the daily chart here. And we have a support line right here, which is a low. You can see it as it was also providing resistance here. $0.6680. Resistance at the peak. $0.6865. Readjusting the chart. Here you go. Let's start with the R3. 0.7155. 0.7030. 0.6865. 0.6680. 0.6535. And finally, let's go all the way down. 0.6280. Now, if the Elliott waves are correct, so I've mentioned 1, 2, 3, 4, 5, then we should expect a correction somewhere here. Let's color this in blue. And a third. That would be A, B, C. It's going to be interesting to see whether that pans out or not. It could go even a little bit lower, say for example breach the S1 0.6680. But if the Elliott waves are correct, then at this point they should start rising, correcting higher, and then drop substantially. It would be also very, very similar to a head and shoulders formation. Let's have a look now at USD CAD. Zooming in a little bit, that's better. Okay, there's a nice upward movement here. Back to black. Let's reposition the labels. Now we have USD CAD, which seems to be on the upside. Interestingly enough, there was not that kind of movement that I was expecting. I was expecting, after the release of the US and the Canadian employment data, for USD CAD to move decisively higher, as we had a substantial divergence between the better than expected US employment data and the not so good Canadian employment data. And that should, or at least expected, USD CAD to be pushed higher, substantially higher, possibly above the 1.3405 resistance line. It did not. On the contrary, at some point it even corrected quite low. But the bullish movement seems to be there despite this shadow here. So we maintain an upward trajectory which could breach the 1.3405 and start aiming for the 1.3535. On the other hand, we have to note that volatility has dropped substantially, and that may allow the sideways motion to be continued. Note how the Bollinger Bands have narrowed. It's very, very characteristic. While for bearish outlook, I would require the pair to breach the upward trend line, the first signal that the upward movement has been interrupted. But I would also require the pair to breach the 1.3315, possibly even with the S1 of turning into a resistance line and providing some resistance should the price action dive below it, with the next possible target for the bears being the 1.3150. That could narrow a little bit, could go a little bit higher, somewhere here. And that would be the 1.3170. Let's go 75. Yep. At this point, allow me to have a second check on the S3 where it actually rests. It has to be a way, way back. Oh yeah. Substantial support back in September. Back in September 2022. Okay. So to cut the long story short here, we tend to maintain our bullish outlook for the pair, and that may push USD CAD to break the R1 1.3405 and start aiming for the next resistance line, which is set at the 1.3535. That's being also supported by the RSI indicator, which, okay, it's not as high as 70, but it's still in bullish territory in our opinion. It's at 63. On the other hand, there are some signs of stabilization, and I would expect a stabilization to be signaled by two events. A, that would be the breaking of the upward trend line. B, a possible respect of the S1 1.3315. These two elements would allow practically the pair to remain between the R1 and the S1. It's a corridor which is around 80 pips. Not much, pretty narrow on the contrary. While for a bearish outlook, despite that being rather remote right now, it could happen, and that would be signaled, in our opinion, should the price action breach the upward trend line, but also breach the S1 1.3315 and start aiming for the S2 1.3175. Okay, let's have a look at gold. A very, very interesting movement from gold. There's a nice downward motion. The pair is forming lower peaks and lower troughs. The RSI indicator is nearing the reading of 30. In this case, it's characteristic how the US employment report for December increased volatility, and it would be interesting to actually see what happened on the minute chart and how that affected gold. There you go. Gold's price practically dropped $14 upon release of the US employment report and the following minute. But note how quickly the lost ground was recovered. And actually the precious metals price moved even higher before correcting lower. So for the time being, back to the forward chart, we tend to maintain a bearish outlook. Fundamentally, that could be explained by the rise of US yields. We saw over the past week US yields rising, and we're talking about the 2-year, 5-year, and 10-year yield rising, more or less taking some of the shine of the shiny metal. And given that gold is not interest bearing, while on the contrary bonds are, and interest, the yields are rising. So that's pretty much a very appealing alternative to gold right now, which could drive gold's price even lower. I would be highlighting here the release on Thursday of the US CPI rates there for December. And the interesting element of the US employment report for December on Friday, in my opinion, was the fact that the price action, or if you prefer, the market's expectations may have wavered for a short period, but they recovered. And it seems as if the market needs more concrete evidence for a possible, I wouldn't say easing, but for fewer rate cuts on behalf of the Fed. Now, the US CPI rates for December is another big test. And given also gold's use as an anti-inflationary financing tool, that could have another effect on gold's price, especially should the CPI rates accelerate as they are expected now or even higher. Should that be the case, I would expect the US dollar to strengthen, gold's price to sink, possibly start aiming for the 1988 support line. It's a wide distance, I know it, but it's quite possible. And up until Thursday, we have lots and lots of time. Okay, a small view also of the US 500. It's the daily chart. Note how the price action has moved below the 4,700 support line, now turn to resistance. Allow me to turn this into resistance line. Note how the volume has increased. And in my opinion, okay, that was initially for the bulls, but now it's for the bears. Yet it's slowly falling, which may hold the bears a little bit. Also, the RSI indicator is still above the reading of 50 despite correcting lower. which is not so conclusive of bearish sentiment on behalf of the market. Let's have another support line though. This is a nice show. This is a nice peak. I'm going for this one. In green, 4,330. Should the bears maintain control, then we may see the price action. I'm going to widen this a little bit. Oh, nice, interesting correction higher. Then we may see the price action actually starting to aim for the 4,600 support line. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello everyone, my name is Emily and welcome to another one of our videos. Today we'll have a look at currency carry trade. A currency carry trade is one of the most famous trading strategies in forex trading. A currency carry trade is when you buy a currency with a high interest currency against a low interest currency. Carry trading involves holding a forex trade when one currency has a higher interest rate than the other currency in the pair. The most famous carry trades involve buying currency pairs like the Australian dollar against the Japanese yen and the New Zealand dollar against the Japanese yen, because these pairs have interest rate spreads that are very high. A trader can make a profit between the difference in the interest rates of two currencies as long as the exchange rate between the currencies does not change. Many professional traders use these currency carry trades because the gains can be very big when they use leverage. However, the bigger the potential gain, the higher the risk. The currency that is exchanged in a currency carry trade transaction is known as the funding currency. A funding currency usually has a low interest rate. Traders borrow the funding currency and take short positions in the asset currency, which has a higher interest rate. The best time to get into a carry trade is when central banks are raising or considering raising interest rates. Also, these trades work well during times of low volatility since traders are willing to take on more risk. As long as the value of the currency doesn't fall, even if it doesn't move much or at all, traders will still be able to get a return. However, a period of interest rate reduction does not provide great gains in carry trades. When rates are falling, demand for currency also tends to fall and selling of the currency becomes difficult. Basically, the carry trade can result in a profit if there is no movement or an increase in interest rates. Hope you found this video useful and interesting. Thank you so much for watching us. Bye-bye.
So hi everyone, welcome to our Trade Management Series webinar. So this is brought to you by Everest Fortune Group in collaboration with IronFX. So today's first part of our series will be on scalping. Okay, before we get started, just a risk warning. Okay, Michael is a scalper most of the time. That's cool. I do like scalping as well. If I don't have that much time to sit in front of the computer, I think it's a good strategy as well. So we'll go through 3 powerful scalping strategies at the end of the webinar. So you guys can keep a lookout for that. Okay, so a risk warning, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda. We'll just do a brief intro to scalping for those of you guys who aren't familiar with it. And then we'll take a look at Fibonacci confluence and where you should place your stop loss and take profit. And then stay tuned to the end to where we'll go through 3 powerful scalping strategies. So I'm your host for today. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. And if you guys were curious, you can feel free to connect with me on LinkedIn as well. It's just my name. Okay, so what is scalping? So it's a fast-paced, exciting, and mind-rattling all at once. So basically, it's where you take trades for short time periods. So you grab very small amount of pips and you risk very small amount of pips as well. So you're basically taking advantage of market volatility in this case. And the time frame, if you guys were wondering, for scalping is normally on the shorter side, just so that you can catch all of the market volatility, the market movements. So it's briefly, we think that 1 minute to 5 minutes is a little bit too short. So because the time frame is so small, it can get really, your charts can get really noisy, and it might be a little bit difficult to catch all of the movements and conduct your analysis because of the constant movements. So we like to stick with 15 minutes to about 1 hour for scalping. Okay, so why scalp? There are known unknowns. Okay, so what we mean by this is a good example would be if the NFP is coming out tomorrow, for example. You know that the event is coming, but the outcome is unknown. So these events can really mess up a trade. So in this case, you would use scalping so that you can avoid any um, any known unknowns, basically. Okay, and locus of control. So let's use weather forecast, for example. So if there's a 1 hour forecast versus a 1 week forecast, you are likely to have more control over what's happening in the next 1 hour versus over the next 1 week. And new opportunities every time you open the chart. So market moves really fast on the M30 and H1. So there are new patterns every couple of hours. Okay, so how much time do you need to scalp? Time commitment wise, you basically have to find the trade and set the trade management. We'll talk a little bit about stop loss techniques and stuff like that later on. But that's basically all you need to do. Set the trade, make sure that your risk management strategies are intact, and that's it, you're done. And then you just have to review it every few hours. So the holding time is typically from a few seconds to a few hours, depending on your own strategy. So our recommended time to trade, or rather the different amounts of time that you have to put in will be 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So it's not too time consuming. And it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so this talks about your trading stop loss, the different stop loss techniques, which we will briefly talk about later on in our slides. How much leverage do you need to scalp? So this is typically quite a high leverage strategy. So it's about 1 to 100 onwards. And you normally would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. That's just our recommended amount. Of course, it's completely up to you. Decent leverage of at least 1 to 100 is preferred, but not necessary. So if we're talking about what exactly is leverage, so if we take, for example, a trader who deposits $1,000, so they can use $100,000 with a 100 to 1 leverage in the market. So this can greatly magnify your returns, but also your losses. And this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So what this means is that with an account size of maybe $1,000, right? Only $10, or which is 1% of 1,000, should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their 1,000 into 2,000 quickly. Okay, so yeah, so if you can do it with $250, then you can do it with 2,500 and 25,000. But definitely don't rush into scaling up. Okay, now let's get into the 3 powerful scalping strategies first. Okay, so firstly, we have the horizontal pullback strategy. So if you guys were here for our recent support and resistance series on our webinars, yeah, this would be familiar with you. Next would be our Fibonacci retracement strategy. So it's pretty straightforward. You're basically using Fibonacci retracement to see where prices will retrace towards. And lastly, we have the 90 tick strategy, or what we call Fibonacci extensions. So let's get into these now. Okay, we're going to start with horizontal pullback strategy. So a horizontal pullback basically means that we are expecting price to pull back or retrace back to that level. So in this example, we see that we have a multiple swing high resistance, this red area. Okay, we have 3 swing highs that all line up along the same area. And then price surpasses this resistance. So it breaks out of it. And since it's breaking out of it, we are expecting price to return back to that level. If you're wondering why we can expect price to return to this level, it's because of this multiple swing high resistance. So basically, the more number of swing highs or swing lows, if we're talking about support, if we have more swings that line up in the same area, price is likely to return and respect that area again. Okay? So in this case, since it's a resistance at first, we are now expecting it to become a support. So from a resistance, once price surpasses it, now we call this a pullback support level. Okay? If we are looking at a multiple swing low support, same thing when price breaks past the support level, we're expecting price to retrace back to that same level. Okay, in this case, we are calling it a resistance. Okay, let me know in the chat if it's a little bit confusing. Okay, but here's a couple more examples. So the key basically to scalping is making sure that you have a bunch of indicators and a bunch of graphical analysis that all supports your analysis. So if in this case we have price moving below the Ichimoku cloud, so that's a bearish signal. Okay, and price has also broken out of this swing low support. Okay, so we're expecting it to return back to that level. And you can see that's exactly what it did here. Okay. Next, let's talk about the Fibonacci retracement strategy. So firstly, this is an example of an insignificant swing. So just a reminder that these swings should not be used as Fibonacci points. Okay, because the swing highs and the swing lows are too insignificant. Instead, this is what you should be looking for. Really clear troughs and peaks and very clear market movement. So this forms the basis of all starting, middle, and ending points when we're using Fibonacci levels. Okay, so you shouldn't pick swing highs and those that are not significant, meaning that they need to have a relatively big move before or after it. So as a rule of thumb, you can use at least 15 bars before or after to see if they are really significant swings or not. Okay. Another reminder, okay, when you're drawing Fibonacci retracements, projections, extensions, or expansions, whichever you are doing, there's one important rule that you have to follow, and it's that your Fibonacci line must follow price structure. So your trend line can deviate from structure, but not by too much. So if you look at this example here, you can see that price doesn't really follow price structure over here. Okay, so this is what we've drawn is the shape of the price, and our Fibonacci just cuts through the shape entirely. So the trend line deviates from price structure by too much in this case. Okay. Next is our strategy. So the tool we're using here is Fibonacci retracement, which you can get from, it's the same tool that's on TradingView as well as MT4. So Fibonacci retracement percentage, excuse me. So for the percentages that we use for retracement, we use millimeter 5. So it's 23.6, 38.2, 50%, 61.8, as well as 78.6. So those are the levels that we use for Fibonacci retracement. Okay, so let's do a bit of a recap first. When you're picking the starting point, so basically your entry or your support or resistance levels, there are some rules that you have to follow. Firstly, we want to check if there's a swing high or low, pullback, or overlap level. So we talked about pullback already. Overlap, if you weren't here for our support and resistance, overlap basically means that there is a swing low as well as a swing high that are at the same level. Okay, that's what we call an overlap. So secondly, we want to make sure that our starting point goes back as far as possible. And you want to make sure that it doesn't intersect too many bodies of candlesticks, but the wicks are fine. So you see in this case, it's just the wicks, so it's an okay thumb. But we are preferably looking for really significant swings like over here. Okay. Another example here, we're cutting too many bodies of candlesticks over here, which is why it's not preferred. If you look at the green thumbs, we have really nice multiple swing highs that line up nicely, as well as overlap levels once the swing low touches that same level. Okay, and we see here as well another swing high here. Okay, once again, cutting too many bodies of candlesticks over here, which is what we want to avoid. So in this case, in order to rectify the situation, you can actually just stop your support level over here. So it's a support level because price has already surpassed this resistance, thus making it a pullback support because we're expecting price to pull back or retrace back to this level. Okay, so we talked about the pullback already, so I'm just gonna really quickly skim through this. I'm just gonna show you guys the GIFs. Yeah, and show you guys how we look for pullback support and resistance levels. Okay, so here we are making use of two levels, or rather two Fibonacci trend lines. Okay, we have this really long one here and one small one here. And then we highlighted the area where we are expecting price to retrace off of. Okay, so the 61.8 and the 38.2 that we see here lines up nicely with this swing low. Okay, so a pro tip is that when a pullback support level lines up with a Fibonacci level, in this case we have two Fibonacci levels, so it's a very powerful level. Okay, because for this webinar we are focusing more on scalping strategies, so the time frames that we're looking at are on the shorter side. So briefly from 15 is like the lowest that we go, 15 to about 1 hour, preferably 30 to 1 hour for scalping. But this strategy can be used for pretty much anything, even if you are a day trader as well. Okay, but yeah, for this webinar, mainly focusing on the shorter time frames. Okay, we looked at these examples earlier. No worries, friend. So we have another example here, the pullback resistance as well. So you can see that we have a significant swing low here, right? And price has surpassed this level. So once price has surpassed it, it then becomes a resistance because we're expecting price to pull back to this level. And you can see that's exactly what it did. If we move on to overlap, so I already briefly mentioned it earlier, but yeah, this GIF basically tells you what an overlap is. It's when there are bulls and bears that are respecting that area, which is why it's an important point to take note of. Similarly, if overlap areas line up with other elements like Fibonacci or graphical elements, then it'll make it even stronger. Okay. Here's another example. I think you guys have kind of gotten it by now. But just another example in case you weren't clear. So this is a pullback resistance first, okay, because price has surpassed the swing low level. So it's surpassed it, we're expecting price to pull back to it. And once price pulls back to it, as we see in this GIF, and reverses off of it, it then becomes an overlap level instead. So the difference is that the difference between pullback and overlap is that once price reverses off of the level, then it becomes an overlap level. Whereas for pullback, we're just looking for price to surpass it. Okay, so now that we know what overlap and pullback levels are, we can combine them to find strong resistance and support levels. So sorry about the text, but here we have a big swing high resistance level. Okay, price surpasses this level and becomes a pullback support. So we expect price to pull back or retrace to this level, the same rate level here. Okay, and in the green arrows, we see price retrace this level and bounce off of it perfectly. Once price bounces off the pullback support, it then becomes an overlap support level. Okay. Combination of pullback and overlap. Same concept over here. We have two swing high resistance and then a pullback support once price surpasses it. And then we can see price actually respected the area twice in this case. And then once price bounces off of it, it then becomes an overlap support. So actually, even after the first bounce off of this level, it's already an overlap support. Okay, but yeah, we normally when it happens once, you can expect it to happen again. Okay, another example here. In this case, we have prices respecting this 33420 level many times. Okay, with swing low supports, then a pullback resistance, and then it pull back to our resistance 3 times, and then a pullback support, and then back to our support level. Okay. Here's another example. Okay, we have this double swing low support. Price breaks out of it. Okay, we're expecting price to retrace back, but we also have a Fibonacci retracement. You see here 61.8 that lines up with that same level. We also have this 100%, this bigger Fibonacci level here with a 50% Fibonacci level that lines up with the same area. Okay, so this makes it a confluence area, which basically means that you have multiple Fibonacci levels that line up with the same area. Okay, so the reason why that's important is because price is always more likely to be attracted to these areas of confluence. And you can see over here that price was attracted to this area, okay, and then we're expecting it to bounce off again. Okay, like we see over here. Okay. So like I mentioned earlier, we typically want to try and get use graphical techniques, indicators, different kinds of um indicators basically to support your analysis. Okay, here we see that we might have a descending trend line, but you guys know that a valid descending trend line, you need 3 significant touches because 2 is quite common, okay? But we have price moving below the Ichimoku cloud, okay, but it looks like it's breaking out. We also have this descending, almost descending trend line here, okay? And we also have a Fibonacci retracement where 38.2 lines up with our trend line over here. Okay, and we're also making use of stochastic in this case, where we see that we have 3 swing highs that all line up together. So what this is called is a hidden resistance level. Okay, which basically tells us that price is likely to drop again, like we see over here. Okay, we see it happen twice. Price is making a lower high. Okay, but then over here on our stochastic, it's the same resistance level. So we can expect it to happen here as well. Okay, any questions about this? Okay, all good, let's move on. So this is our third strategy, which is the Nike tick strategy. So it also makes use of the Fibonacci retracement tool. Okay, but instead we are using the levels that are more than 100%. So not included here is the 161.8 level as well. So we use 127.2, but we also use 161.8. And this is basically how you use it. Okay, so you have a starting point and an ending point, which is where you draw your Fibonacci trend line. Okay, and the shape that we're looking out for is basically like a Nike tick. So you have you want to make sure that the tail of your tick surpasses 100% of the starting point. Okay. Yeah, and then you see you're projecting where price will reverse off of. So in this case, price reverse off of the 161.8, and then we expected a reversal here. Maybe I'll just show you guys like where you guys can find this on our website. Okay, so you can find it over here. This is just the forexarmy.com. Maybe I'll just pop it into the chat. The Okay, so we have a bunch of trading guides and tools as well. So the tools are mainly for MT4. Just a bunch of indicators, free indicators for you guys to download. Okay. Yeah, support resistance guide and how to draw Fibonacci retracement correctly. So if after this you are still a little bit confused, you can go ahead and look at the extensions. So the extensions is basically what I'm referring to now, the Nike ticks. Okay. Retracements are really basic Fibonacci levels that are important as well to know how to use. Okay, so we have the clear market structures. You can see what to look out for. Yeah, you can go and explore this on your own along with the different confluence areas. Okay, and we'll talk a little bit about this towards the end of our webinar today as well. But yeah, if after this you're a little confused, you can go ahead and check the Forex Army out. Okay, so another example here of a Fibonacci extension. Here it's pretty small. Okay, we have a really small tick here. So you can see the hit from the 100% to the 0%. That's where I've drawn the trend line. Okay, so I've drawn the trend line and then I'm projecting where it goes. So I see that firstly, I have a swing high resistance here. Okay, so this is my where I'm projecting price to go towards, but I see that it's also in line with a 127.2% Fibonacci extension. Okay, so it makes it a significant level, like you can see over here. Hi, Azif. Okay. Yeah, so this is the shape that you want to be looking for basically, with the head of the tick like this. And you can only use this technique once price has surpassed more than 100%. Okay, but the shape is like a Nike tick. In this case, I'm showing you guys an example of an inverted Nike tick. So the shape that we're looking for, same thing, we're looking for the head to be shorter than the tail. So the tail has to surpass 100%. Same idea, completely the same. It's just that it's upside down. Okay. In this case, we see that price has surpassed the 127.2%. Okay, so we are expecting price, or rather we're projecting where price will go towards. And in this case, we have price, we have a swing low support that lines up with the 161.8% Fibonacci extension. And you can see that price is reversing off of this level. Okay, so here's how it works, or what we are looking out for when we are using this technique or this strategy. Okay, so we're watching for the reactions off of the 127.2 and 161.8. We're expecting it to reverse off. That's basically what we are doing with this strategy. Okay, notice how we only go in with the Fibonacci extension after price breaks out of the 100% level. Okay, let's move on. So here's another example of the Nike tick strategy. So the time frames that we recommend for this are 30 minutes, 1 hour, and 4 hours. The entry criteria is that once price breaks out of the 127.2%, stop loss level, okay, these are just recommended areas. So you don't have to follow these closely because charts are completely different. Okay, I don't think you guys can find a chart that looks exactly like this over here. So these are just our recommended areas for you to reference. Okay, so our idea invalidation level is the 138.2. Break even is 11% of the recent move. 50% take profit is also 11% of the recent move. Full take profit, 22% of the recent move. And then for bonus, we will go in with other Fibonacci techniques like retracement, expansion, projection, and also support and resistance, like we previously mentioned. You're going with your pullback as well as your overlap levels. Okay? So this really just for your reference, okay, there's no it's not like you really have to stick to these levels. It's just if you're starting out and you don't know where to place your levels, you can just follow this guide. Okay, so here is the long example. Here we have two Fibonacci techniques that we're using. Okay, firstly, it's a little bit hard to see, but we are firstly using a Nike tick. Okay, let me show you guys where the Nike tick is from here to here. Okay, and then we see price surpass the 100%. And then we see the 127.2%, or it looks like price is approaching it here. Okay, and then we go in with our projection. So our projection is from here. Projection uses 3 points, okay? So the starting point here, middle point here, and ending point here. Okay, and for projections, we use 3 levels, 61.8, 78.6, and 100%. So we see here that the 61.8 lines up with the 127.2 at this level here. Okay, so we can see that price reacted off of it nicely and shot back up. Okay, maybe another technique that I just want to briefly mention is our Fibonacci expansion. So for expansions, we use, let me try and find it. We use the negative levels. Okay, we use the negative levels, minus 27.2 and minus 61.8. So for this, we look for the flash kind of shape like you can see here. And we can often use this Fibonacci expansion with your projection levels. So like I mentioned, the 3 points. The 3 points is your projection, and we normally can use that with the negative levels. So you can see here, the negative levels, we have minus 27.2 and minus 61.8. And you can see how price reacted off of the minus 61.8 really nicely. Okay, now we're going to talk a bit about trade management with Confluence. Okay, so a good habit is to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to areas of Fibonacci confluence, like we mentioned earlier. So if your stop loss is right before it instead of beyond it, you will likely get stopped out before the market reverses. Okay, so this is one of the reasons why people wonder why they get stopped right out before market starts to reverse, and then they start to complain about stop hunting. Take profit, on the other hand, you want to place it before a major confluence area. So when price reaches the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it because obviously we're expecting it to reverse. So instead of it reaching your profit target, it's likely to reverse back to your entry instead, or maybe even to your stop loss. Okay, so and then people will complain that the market is being manipulated because they missed their take profit by 1 pip. So here's an example of how you can place your stop loss and take profit, just to maximize your wins and minimize your losses. This is also on the forexarmy.com website, so you can go ahead and take a look after this webinar. Okay, Fibonacci confluence. So multiple Fibonacci retracement lines up together, so we know that this is what makes a proper Fibonacci confluence, and the example is over here. Okay, we have minus 27% Fibonacci expansion, as well as the 161.8 Fibonacci extension that all line up nicely here. Okay. So maybe just to break it down for you guys, the minus 27% Fibonacci expansion, we're looking for flash or lightning bolt kind of shape. So you can see that over here. Fibonacci projection, similarly, we are also looking for a flash shape. That's why I said these two can likely be used together normally. Okay, so you can also see it, see the lightning bolt shape. And then the 161.8 Fibonacci extension, this is our Nike tick strategy. You can see that the Nike tick is inverted in this case. Okay. Yeah, and you can see price bounced off of this level. Another example here, we have the 127.2% Fibonacci extension, right? So this is the extension, and it lines up with the 61.8% Fibonacci projection. So the 3 points over here. Another example, 100% Fibonacci projection. So you can see the 3 points once again is your projection. I think you guys can see the lightning bolt shape here. And then we use a 127.2% Fibonacci extension. So you can see the Nike tick shape. So what we are looking for is basically levels that kind of look like this. So as long as you have two levels that line up nicely. Okay, so we're combining Fibonacci methods again. In this example, Fibonacci expansion. So you can see the lightning bolt shape here. And we have a minus 61.8% and the 161.8% Nike tick. So you can see the tick here. Okay, and we are projecting it to reverse off of this confluence area here. Okay, so we would expect it, or rather we would project it to reverse off of the higher area, obviously only when price breaks out of this level here, which is why it's good for scalping, because then you can take these small movements pretty easily. Okay, another example here. Okay, the minus 27.2% Fibonacci expansion. This is once again the lightning bolt shape. You can see it really clearly here in this case. And then the 100% Fibonacci projection, also lightning bolt shape. And then the 127.2% is the Nike tick shape. So you can see it. It's inverted in this case, okay? And all of these three levels line up and we see price reverse off of this area. So it's attracted to these areas, but it's not likely to go beyond it. So it'll be attracted to it, it'll test this level, and then it'll reverse off. That's the kind of movement that we're looking for here. Okay. If we look at dynamic take profit and stop loss placement, okay, your swing high would be your stop loss in this case because we're expecting price to hit towards our take profit. So we're going in for a sell in this case. Okay, so take profit is your swing low resistance here. Entry is at this swing low support that's turned into a pullback resistance level. Okay. And this level is also in line with the 78.6% Fibonacci retracement. So price hits our entry really nicely and reverses off of it and hits towards our take profit. Okay. Another example here. This is the same example, sorry. But in this case, I'm showing you guys that we have another Fibonacci retracement. No, this is a projection, sorry. So we have a projection here with a 78.6% that lines up nicely with our take profit. Okay. And then we see price just touched our take profit before reversing off of it. So this is why it's so important for you to know where to place your take profits and stop losses. Okay, because you can see here, it'll drop and then reverse off of it really quickly. So you have to be able to catch that touch before price reverses. And you can see it's really good that it touched nicely because it went straight to your stop loss after that. Another example here. Okay, we have price breaking out of the descending trend line. So since it's breaking out of it, it's giving us a bullish signal. And then we have this entry level. We have our entry level here, which is a significant level. You can see the number of times that price has tested it. And then you can see that we have a lot of Fibonacci levels that line up nicely. Okay, we have the minus 27.2 Fibonacci expansion, 127.2 Fibonacci extension as well. Okay, and these all line up with this level here, which we then make our take profit. So if I had placed my take profit above the confluence area, price actually reached it and reversed off of it. So it would have missed my take profit by a few pips. And it would have hit it straight to my stop loss. Okay, whereas if I had placed my take profit below the confluence area, price hits our take profit nicely before reversing back down. Okay. Okay, that's it for my slides. Let me know if you guys have any questions. Maybe just to summarize, the 3 scalping strategies that we went through today, okay, were the Nike tick, which is the last one that we went through, and then the retracement as well as the pullback. So basically, you can use all 3 together, and that's the best strategy, is to combine all and form a confluence area so that you know which areas to look out for, and of course, know where to place your take profit and stop loss levels as well. Okay? Once again, if you have any questions after this webinar, feel free to check out forexarmy.com. Most of the information is there. How do we access previous sessions? I'm not sure if it's on YouTube. I think you can check YouTube first, the IronFX YouTube. But if it's not there, you can email IronFX. Okay, thanks so much, Wayne. Hope you learned something from this. Yeah, if you guys don't have questions, feel free to leave the session. Have a great rest of your week, and I will see you guys next week for our second part of this trade management series. And you can find me on LinkedIn if you want. Thanks, friend. See you guys next week. Bye, everyone. Thank you.